Hello friends, this is Vijay Bhambwani. I've been trading these markets since 1986 and through my videos I want to help traders achieve a better trading outcome from their journey in their trading careers and lives. Now, I don't provide any kind of paid services, so take this video in that particular context. Now, the thumbnail of this video says, "Are bulls walking into a trap?" Now, this indeed has to be analyzed not just on any goosebumps on your skin, the hair standing on end on your arm or something, but this, as you know me for, is a pure data-driven analysis of what the numbers tell me, and I want to share this study with you. Now, I also in this video want to share something about your learning process. No, I am not launching any paid mentoring or training services, and I don't want any of your money and all that, but do watch the video till the end. I need to talk to you about that. So let's get started. I told you since the end of 2023 that 2024 would be a forced bull market because of elections in almost 5 dozen countries around the world. This was the video. The hyperlink to all the videos that I want you to see are in the pinned comment below and in the description below this video. So I won't waste your time in getting into what I said in each video. Then I told you in these two particular videos that I expect pro-cyclical hysteresis in financial markets starting from calendar 2025, and lo and behold, we are there. I, through my Telegram post, told you that there would be a phalanx formation first when the pro-cyclical hysteresis phase begins in the market. Sure enough, it did. Then I told you there would be a pincer movement to box retail traders into a corner. That also occurred. I particularly warned you against cost of funds because the retail guy is constantly involving more and more money into the market, and money has a cost to it. Now, if the asset that you're buying with that money is rising faster than the cost of money, you're fine. So you're basically justified in taking that risk and you are in a net gainful position. But if the cost of money is higher and the asset price is rising slowly, this is cost of money rising fast, this is asset price rising slowly, you are losing. This is something that I explained you and I urged you to study Dick Stoken's 3 books, which I gave you hyperlinks to, which were available for reading online for free. The hyperlink is again in the pinned comment and the description below this video. Now, this is why I think that retail traders are walking into a trap. They don't understand what they are getting into. Take a look at this chart. This is a weekly chart of the Nifty of about a year and a half. What you see is very large declines each and every month starting from June 2024. The indices then clawing higher and higher, still making new highs after a deep decline. That shakes the conviction of an average retail guy, but somehow, don't ask me, somehow he clung on. Why do I say clung on? Is there any backup, any data to prove my hypothesis? Yes. My name is Vijay Bhambwani and I don't talk without data. All right. So he clung on and then he patted himself on his own back saying, look, I was justified in holding my long positions. Here is the market making a new high. But was it? We'll come to that. So finally in September, end of September, market peaked out. When it fell, it failed to make a new convincing high, and from October onwards it's been grief for the buy and hold investor / trader. Now, why am I saying that cost of money mattered? Take a look at this monthly chart. Now, here is the Nifty, and also the same would apply to the Bank Nifty. Once it made a peak in October 2021. Remember, I am talking of October 2021, not 22, not 23, not 24, 21. It made a peak, fell sharply for a couple of months, and then started rising again. And if you've been connected with me long enough on social media, I started warning you that the cost of funds is only going to go higher from here. Liquidity will become a problem. It was beginning to be a check writer's market. So it's turning out to be a check writer's debt market. They are asking and getting higher rates. I'm getting calls from my fixed income brokers each and every month telling me, hey, Vijay, I got a deal only for you just because I know you for X number of years, limited time only. So and so company is offering you so and so interest on their corporate deposits, on their fixed income, on their debentures or fixed deposits, etc. So I keep telling them when they raise the interest rates further, give me a call later. Sure enough, many a times the same company has approached us again and again, which tells me that it's a check writer's market. All right. So when these guys, the bulls who are buy and hold bulls, bought the Nifty and the Bank Nifty in the futures after the decline or at the peak of October 2021, need to calculate their rollover costs for that many years. You know what? From October 2021 to March, or maybe now it's April 2025, you have been carrying forward your long positions for over 3.5 years. So you've paid cost of carry. And even if you were to calculate the 10-year benchmark bond yield as the annual cost of funds, which it is not, even if you were to add annual cost of funds at the rate of 6.5-7% ballpark, the water has exceeded your nose levels by now. Calculate both cost of carry, which is rollover cost, and cost of funds, which you have deployed in the market. You're losing money. Number one. Point number two, and this gets even more serious. The Honorable erstwhile RBI Governor, Mr. Shaktikanta Das, in a press interview, gave a statement that should have got you sitting up in your chair. I have been posting on my Telegram channel all the relevant data. That is one-stop shop where I share all my thoughts. For the simple reason that Telegram is the only platform that allows me to upload any kind of file format and reports that I want to share with my online family. I do have a WhatsApp channel. I do have a YouTube community, but file uploads are very, very limited. The type of file uploads are very limited. So on my Telegram channel, I shared that interview with the RBI governor that he gave to the media, saying, thanks to the linking of all transactions of people by way of Aadhaar and PAN card, we have now got data that an average retail borrower may have borrowed from multiple MFIs or microfinance institutions, MFIs. Now, MFIs are basically NBFCs and other microfinance institutions who borrow money from the scheduled commercial bank at a relatively lower rate of interest and lend money to people who otherwise would not have got loans easily from the bank. If the loan amount is less than 50,000, and very cleverly applicants write loan wanted 49,999. So it's under 50,000. So it's a little more lenient and easy to get a loan under 50,000 from MFIs. And the Honorable erstwhile RBI Governor said we have evidence to believe that these borrowers have borrowed money from more than one MFI or microfinance institution, and in some cases up to 3. A few months down the line, I shared a NDTV interview in which a research analyst of a very respected sell-side brokerage shared data that some, very, very few, some borrowers may have borrowed from more than half a dozen MFIs. Very few, I repeat. And is it possible that this money was also going into the stock market? Now you have a problem. You have a problem because A, your meter is ticking on the loans that you have taken. B, your stock prices are down. Is there any way you can ascertain how much loan from the MFIs have been taking and it has gone into what? Impossible. If somebody has it, all the more power to them. I don't. But since I'm all about data, I'm going to share data that I do have and what you can also download every single day, and that data is free from the NSE's website. Every day late in the night with 1 day delay. The reason why it is a 1 day delay is because they collect data from all the broking firms, the depositories and custodians, and then release it on the next day. And this data is almost the last data point to be uploaded on NSE's website every day. It is on the download all reports. Don't worry, I'm going to give you a hyperlink to the relevant page. All you need to do is go on that cash market all report download page and click on the file titled MTF file, margin trading file. Now you will see as to how much money an average retail guy has availed loans for buying. The data is available in two formats. It is for each and every stock that has been borrowed to money has been borrowed to buy, and the data is available in two formats. Number one, you have number of shares, number of ETFs, number of units. All right. Number two, it is the value. Now, before I go further, let me tell you that some of my friends, I have met them over the years, especially since I've been in the market since 1986. You tend to know some people. All right. Now, I have been seeing research reports and in the public domain data being shared of the MTF, margin funding, that is quoting the value in rupees. I beg to differ with this kind of reporting. Why? Supposing you've borrowed money and when the share was $100, okay, of course the broker has given you a haircut. He'd say you put up 30%, 25% or whatever it is applicable for that stock, and I'll fund the remaining. Now he's funded you when the price of that share was 100 rupees. What happens when the price of the share falls to 70? He will ask you for more money because your haircut has obviously increased due to the price decline, and you have also paid. You've not defaulted, but you've paid. But the MTF will show that the rupee value of the borrowing has come down. Does it mean that the number of shares against which money has been raised and borrowed has come down? No, the number of shares remains the same. So you need to take this data in number of shares and not in rupee terms. Don't make that mistake. All right. Now, I'm going to present you analysis of the MTF vis-a-vis the Nifty in two formats. Number one, it is a weekly chart. Number two, it is a monthly chart. The monthly chart will give you an analysis of what happened over the last 30 months, 2.5 years. And the weekly chart will give you an analysis of what happened over the last 30 weeks. All right, that's 7.5 months. So here goes. Take a look at this chart of the Nifty on a weekly basis. What do you see? You will basically see that when the Nifty has been rising, the MTF has also been going up. Now, over a 5-week period, and I'm talking about the number of shares, the MTF has risen 1%. Over a 10-week period, it has fallen by 4.22%. Over a 20-week period, it is up 0.5%. And over a 30-week period, it is down 1.22%. What it basically tells you is that retail guys are still no mood to surrender their positions which they have purchased with borrowed money. Remember, the meter is ticking. Are the share prices rising? If the share price is rising faster than your interest cost is ticking, you're sensibly justified in going ahead. Now, let's take a look at the monthly chart, and this is going to be a shocker. Now, the monthly chart tells you that the rally in the Nifty has been humongous. No denying the fact over the last 30 months the Nifty has risen. But look at the way borrowings have risen. Now, over a 5-month period, the Nifty has fallen by 2.83%, but the MTF margin funding has gone up by 1.44%. This is overall market MTF. I'm not just talking of any Nifty ETF or any other Nifty 50 shares. I'm talking of all the shares that are borrowed against to buy. So 5 months, Nifty down 2.83%, but MTF up 1.44. Guys are still nursing a hangover of bullishness. Niche aata hai, kharido. Buy the dip, buy the dip. 10 months, the Nifty has been up 4.39%, but the MTF has come down by 9.94%. Why? Do remember what happened 10 months ago. You had that steep decline in June 2024 once the election results were declared. I told you in the beginning itself in the chart how traders have been taking a big knock month after month, at least once a month, if not multiple times a month. The market has come down only to claw higher. But some of the guys have got shaken out. So over a 10-month period, the MTF is down 9.94, even though the Nifty is up 4.39%. Over a 20-month period, the Nifty is up 19.06%, but the MTF is up a whopping 65.75%. Just see how people are recklessly borrowing money to buy stocks. Over the last 30 months, the Nifty has risen 30.57%, but the MTF has gone up by a whopping 153%. Now tell me, is the meter not ticking? The fact that over the last 30 months, the Nifty has gone up 30%, okay? That means it's risen 1% a month. 1% a month is your rise in the Nifty. I'm not even calculating the execution cost, commission, taxes, STT, etc., etc. Is your margin funding cost 1% a month or higher? And even if it is marginally lower than 1%, is this how much you are going to earn by taking such a humongous risk, waiting for 30-month period and saying, okay, I made 0.20% a month? You are better off putting money in the sovereign bonds, which is why I have been a votary of sovereign debt. Do remember, since October 2021, as this picture tells you, I have been telling you it's time to ladder sovereign bonds, because cost of funds will mean that your riskier assets will not be able to give you returns that they should be giving you. Now take a look at this chart. What does it tell you? It tells you how much percentage of margin trading has increased on a month-on-month basis vis-a-vis the percentage increase or decrease in the Nifty index in the spot on a month-on-month basis. What you will see is that so much enthusiasm was prevalent in the retail traders that in many months when the Nifty was even falling or failing to rise as much, they were jacking up their borrowings in the MTF. And take a look at that huge spike to where MTF has risen almost 30% on a month-on-month basis. Do you know what month that was? That was April of 2024. That is just 1 month ahead of the election results of last year. Enthusiasm went through the roof. Now, what does that tell you? What will be a sign that this enthusiasm is broken? I would look at it as a signal. I would mark this level of MTF as of April 2024. And if A, MWPL, B, MTF in number of shares start to fall and stay below these levels, I would say that the retail guy is beginning to show signs of nervousness. And there, the fast, nimble-footed guy might just exit before the slow guy gets stuck. That could be a trap. Now, the last and final statistical weight of evidence. Why do I tell you to watch the MWPL, market wide position limits? My point is the MTF data is available in the free domain. How many people download it? My point is how many people download the MWPL data every day and make use of it? People basically want ready-made reports in their hands and they need to be told what should be done, which is why nobody downloads it. It is assumed that somebody else is doing all that work and that information would be available in the public domain. So why do it yourself? That's a pitfall. Now, if the MWPL chart, which you're seeing on your screen, is telling you that retail are not yet surrendering their long positions, the decline every 4 weeks is out of pure compulsion of expiry. Every 4 weeks, you're seeing people square up some of their positions rather than rolling over everything, and then it goes up again. Has the MWPL peak and bottom really fallen too much? It has come down, admittedly, it has come down, but has it fallen too much? No. Which means a rank and file trader is still hoping. I can only call it hope because I am a logical statistical systems trader. If at all, any asset that I'm holding is not giving me the yield that even the benchmark sovereign bond is giving me while I and my wife go to the club and have lunch, dinner, watch movies, whatnot, my money is earning more money sitting safely because the President of India is guaranteeing both the principal and the interest on the sovereign bonds. Why would I want to take a risk if the asset is not even giving me that much yield? Now, why am I saying that bulls are walking into a trap? You would still want an answer. Vijay, are you clickbaiting us? Are you gaslighting? No, I don't clickbait. I don't gaslight. All right. Why am I saying this could be a trap? This could be a trap because at some point in time, everybody gets tired. You could starting to feel, look, I've held this position for 2 years, 1 year, 6 months, 2.5 years. I've given you data up to 30 months. I have very little to show for it. I'm exhausted. It's not happening. Especially if the market was to come down some more, you would see this exhaustion and feeling of frustration even higher. At that point in time, a little bit of a sell-off, thanks to the information technology age, social media age, etc. One guy starts screaming, hey, I'm selling, I'm triggering a sell here. It could lead to what is known as a crowded exit. Imagine a movie theater. Do you remember the Upahar cinema fiasco? There was a cinema in North India. It caught fire while a movie show was on. Unfortunately, safeguards were not taken. Some of these exit markings in red, well lit up, were not put up there. There was a stampede and people died. That is the pitfall of a crowded exit. Is it possible that a crowded exit occur in our market? I think that could occur because everybody is holding on to positions since the last 2.5 years without receiving adequate return on the broader market. Sure enough, you could have some small mid-cap, micro-cap shares which have given you stupendous rate of return. But how many of those do you really own? How much of it is your entire portfolio made of? This, my friends, is something that worries me, which is why I'm saying that this market is over leveraged. People are nursing a lot of positions with money that is not their own, and it's not justified. Now, I told you I want to talk to you about your learning process. I have received feedback from a lot of my online family members that they find my videos a little difficult to understand. There are two solutions, one in the immediate presence and one in the very near future. You can click on the setting button in your YouTube browser window on the lower right hand side and choose to see subtitles in the language of your choice. That is immediately available to you. Within a couple of months, YouTube is going to offer free service of dubbing a video provided the video creator allows YouTube to do so. YouTube will dub that video and it will speak in my voice in the language of your choice. So that problem is likely to get sorted out in the coming few months. Now, I understand that these are mathematical concepts and there are many viewers who are having challenges of ELT. ELT would mean English Language Training. Not all of us went to pure English teaching schools, and therefore there could be some problems with understanding what I'm conveying in this video, and especially since quite a lot of my work is about mathematics, statistics, and analysis. It is about doing things. If you are somebody who wants things in a platter ready for you to eat, I do not do any of that kind of work. I don't provide paid services, I don't provide mentoring, and I don't provide buying and selling tips. I am here to meet fellow CEOs of prop trading firms so that we can come together and protect our interests when the inevitable overseas high frequency traders, algo traders, and artificial intelligence based traders come in and set up shop in our country. At that point in time, my dear retail trader, if you have not upped your skills, if you have not raised your skill levels, you will be simply flattened out by the coming tsunami of money that is coming into India. And it is very smart money. I have already told you that disinformation protocol, or basically putting in trades that are trying to convey one thing but are actually doing the other. Disinformation protocol, I warned you after June 2024 would rise. By the end of the calendar year 2024, I told you it is now reaching Maskirovka level. Maskirovka is deception of the highest order, where smart money masks its trade so that the retail guy cannot really get to the bottom of it very easily. The only way out to beat Maskirovka is Matryoshka, or absolute in-depth Russian doll statistical analysis. You take a papa doll, split it open, there's a mama doll inside, there's a baby doll, another baby doll inside the first baby doll. So you peel layer and layer of statistical data and come to the bottom of it. That is what is needed. That is what you will have to do. Stop squabbling about videos being too complex or too mathematical. Try and raise your skill levels. I'm here to help you to the best of my abilities, and I will keep posting and uploading videos as and when I can. The only thing that I ask for you in return, hey, please help me reach out to a wider audience. My lifetime free channel will always remain free. At least do me a favor of sharing my video with all your friends, your family, and social media accounts so that I can help more and more traders trade with knowledge-based trades. Thank you for staying with me in this video. Before I sign off, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my videos are helping you become a better trader and what else you would want me to record in my future videos. I thank you for your patience in being with me in this video. I wish you all the best and I hope you have all the trading success. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Take care. Bye-bye.